Hello everyone, welcome to Legacy Ace Academy. Welcome to this video where we'll be talking about a very important economic concept, that is the ultra long bonds that will be issued by the Indian government in the near future. In today's Hindu newspaper, okay, there's an entirely new article and a new concept, that is India's ultra long term bonds. So in this video, we will try to understand what are these bonds, how do they work, and what is the meaning of bond price, and what is the meaning of bond yield, and how is the bond price and the bond yield are related to each other. Okay, and how are these ultra long bonds will benefit the Indian economy. Okay, so before continuing with this video, I would want you to remind you to subscribe to the Legacy IAS Academy YouTube channel and also press the bell icon to get all the latest updates from the Legacy IAS Academy. Let's begin. If you look at the context, okay, what is the context in which we are talking about the ultra long bonds that will be issued by the Indian government? If you look at this article, which was on 27th September 2023, we're talking about India's ultra long bonds see an ample of demand from insurers, pension funds in H2. Okay, so which means the India's ultra long bonds or ultra long bonds, okay, will have more demand by the insurers and the pension funds, which means the insurance companies and the pension funds are the firms which will be investing in these ultra long bonds that will be issued by the government. Okay, so now let's try to understand what are these bonds and how will the bonds actually work. Okay, see, to understand how the bonds work, we'll have to understand the different types of bonds. Correct. So here, for our discussion, to make our discussion very simpler and easy to understand, I'll take an example of something called as GSEC, that is a government security. GSEC is called as a government security. Correct. So this is just like a bond or a paper that is issued by the government and that is backed by the government, and on this paper it will be written by the government of India, and it will be written in the words that any person who is owning this bond, any person who is buying this bond with the face value of, or let the face value of 100 rupees, okay, the face value of this bond is 100 rupees. Anybody who is having this bond in 1 year, let's take the maturity period as 1 year, 1 year maturity period, okay, will get 10% interest rate. Okay, 10% interest rate, which means at the end of 1 year, the bond yield became, the total price of the bond became 110 rupees and the bond yield became 10 rupees. Understood? This is how the bonds work. So in the year 2023, let's say you buy this particular bond giving 100 rupees, and in the year 2024, that is the next year, the government will give you 10 more extra rupees because the bond yield that as the government has mentioned, it will be 10%. Okay, the interest on the bond will be 10%, and you will be getting 110 rupees in the year 2024. And this is how the concept of bonds work. Okay, so now time to understand what these ultra long bonds are. See, here I have taken the maturity period of 1 year. Okay, there will be some bonds where the maturity period is 2 years. There might be a bond where the maturity period is 4 years, 5 years, 10 years, 15 years. If at all the maturity period is 50 years, then that particular bond is called as ultra long bond. Okay, so the news that is there where the government is coming out with the ultra long bonds, the maturity period will be 50 years and 30 years. For example, in this particular case, you invest in the year 2023, you buy a 50-year term bond, and government announces that year on year, every year, you will be getting an interest of, let's say, 6%. Okay, for all the 50 years, you will get the interest of 6%. At the end of 50 years, you will even get back your principal amount. So this is how the bonds actually work. Okay, see, these bonds are very good way of investment, because there is no possibility of any default here. If you talk about equity or the mutual funds, equity and the mutual funds, in both these, equity and also the mutual funds are very much indexed to the stock market, and the stock market reflects the sentiment of the investor, and stock market reflects the growth of the economy. So we saw during the time of the COVID-19, the Nifty and the Sensex had a very decremental drop. It was a very huge drop with respect to Nifty and the Sensex. The Nifty was almost as low as 7,000 points during the COVID-19. That is, I'm talking about somewhere in the month of April 2020, April 2020, and the last month of March 2020, I'm talking about, where the Nifty was very, very low. And as of now, you can see Nifty crossing almost record highs of 20,000 points. So it is the sentiment of the investors and the nature of the growth of the economy which will define the mutual funds and also the equity investment. But with respect to the government securities or the government backed bonds, it is not the case. For sure, 100% you will get the interest of 6%. Okay, because the government will not default. Correct? So because it is backed by the government, these are considered to be the very good avenues, the most important kind of avenues for the investors. Okay, this is what is the concept of bond. This is how the bonds actually work. Now, next concept to understand: what is the relationship between bond price and the bond yield? Okay, this is a very important concept to understand, and there are a lot of cases you will find this particular thing being asked in the exam. That is the bond price and the bond yield. Okay, I'll take an example of the same example. Let's consider there is a bond whose face value is 100 rupees. It is promising an interest rate of, let's say, 10%, and the maturity period is 1 year. Okay, you have invested in this particular bond. Okay, which means you have invested in this particular bond, correct? So let's say after 6 months, due to some unforeseen medical condition, let's assume that someone in the family fell sick and you want cash, you want to liquidate this cash. See, this is an asset, and you want to liquidate this particular cash. If you wait till the maturity period of 1 year to make or to pay the hospital bills for any of your relative, maybe you will be at a very disadvantageous position. Maybe you will lose the person. So what do? You want to liquidate this particular asset. See, you have bought this as 100 rupees. You have bought this at 100 rupees and the maturity period is 1 year, and after 6 months, let's say, the demand for this particular bond has reduced. And you have bought this at 100 rupees and someone is asking you to sell this bond at 90 rupees. Okay, you don't have an option. You can't look, you can't think that I have lost 10 rupees, because you will be losing a person's life here. So what do? You sell this bond at 90 rupees. Okay, so you bought a bond at 100, after 6 months you sold it for 90. What happened to the bond price? Bond price reduced. Correct? So this person is buying this at 90. If he waits for 6 more months and gives this to the government, what is the amount that he'll be getting? 110 rupees. Okay, see, government doesn't know that you have sold bond at 90 rupees. All government knows is that I have got 100 rupees from you, I will give you 110. Correct? That's all. This person who bought it at 90 is getting 110. What happened to the bond yield? Bond yield increased. Here the bond yield was 110, that is 10 rupees. The bond yield here became 20 rupees. So the bond yield increased. Correct? So compare both. When the bond price comes down, the bond yield increases. The first inference to remember. Second thing, whenever the bond yield increases or whenever the bond yield reduces, bond price goes up. Or we can write it the other way around. Whenever the bond prices go high, the bond yield decreases. Okay, in the same case, you can imagine if the face value of the bond, let's say you have sold it at 105 rupees. So the bond price increased, the bond yield reduced to 5 rupees. That is what the relationship between bond price and the bond yield is all about. Okay, I hope you have understood this particular statement. Now, let's understand what these long-term parking of the funds mean and who are the people who want to benefit because of these 50-year ultra long-term bonds. If you look at this, pension funds and the insurers, for example, the insurance companies, they are ready to park their money with the government for 50 years because they'll be getting the interest rate. Okay, so then this will be considered as a very safe investment. Okay, so the most insurers require long duration bonds, that is why they are doing it. Current 40-year bond is seen as an anchor for the pricing of the new ultra long government securities. As of now, we have the 40-year long bond, and this will be an ultra long bond for 50 years on the line, and this can also be something that the pensioners actually look for. Okay, so this is about the government aims to collect, right? Look at this number, 6.55 lakh crore through the sale of bonds in the October and the March time period. Okay, so this is about the ultra long bonds that will be issued by the Indian government in the near future. Okay, that's it for the day. I hope you have liked the video. If you have liked the video, hit the like button and subscribe the Legacy IAS YouTube channel for more such content. Have a nice day. Thank you.